Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the #1 YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video, we're going to look at the financial statements in general and get into depth with one of the financial statements, which is the income statement or the statement of profit or loss and other comprehensive income. Now if this is the first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. But if you also find this video very helpful to you, we please ask of you to like this video, subscribe to our channel if you haven't, and hit that notification bell so that YouTube gets to notify you each time we get to upload videos into the platform. Now with that said, ladies and gents, let's get down to business. Alright, so starting off by defining what financial statements are. Now, financial statements are basically statements that are prepared by a business to show its financial activities and situation in a particular period of time. So then, financial statements are basically statements that are prepared by a business to show investors how the business is performing as far as finances are concerned, how the business is handling its cash, how the business is handling the capital that is invested upon it, how the business is handling the cash it's gotten from selling its products or services, how the business is performing with the cash it's gotten from other various streams of income. Now, there are four types of financial statements. There are four main types of financial statements, which are the income statement, the statement of financial position, the statement of cash flow, and the statement of changes in equity. Now, in this particular video, we're going to have our sole focus on the income statement or the statement of profit or loss and other comprehensive income, and on other videos to come, we're going to look at the statement of financial position, statement of cash flow, and statement of changes in equity, both as individual subjects. So, starting off with what income statements are. Now, these are financial statements that are prepared by a business to show the revenues it's earned as well as the expenses it's incurred during a certain period of time. The income statement is there to show as to whether the day-to-day activities and the operations of a business have either resulted into a profit or a loss. So then the income statement basically shows investors what the business is all about, like basically the operations of the business, what the business does, the activities the business engages itself upon on a day-to-day basis, but then the only difference is that the income statement just shows all that stuff financially. So then you get to see the revenues earned, you get to see the expenses incurred, you get to see as to whether all that resulted into a profit or a loss. You get to see as to whether how much the business earns as revenue. Can the business control its expenses? You get to see all this through the income statement. Now, all of this, like these income statements are prepared in specific time periods. Businesses could prepare them monthly, after every 3 months, after every 4 months, after every semi-annual or per annual. But, however, I advise you as an investor, when you're going to perform research on companies that are listed in the stock exchange, I highly advise that you get to look at these income statements on an annual basis. Now, why do we say annual? By looking at the income statements on an annual basis, you will get to have a full and a much clearer and a much more realistic picture of how the business can perform during an entire financial year, during the entire year of its operation. Now, take this, what I told you, in comparison to if you were to look at the income statement in segments. Now, we all know that during a financial year, during that 1 year of operation, there are certain seasons where a business could perform really well, and then there's those seasons where a business could have, like, let's say, tough times operating as a business. So then, if you're to look at these income statements on segments, and you're to happen to look at a segment where the business was performing really good, you might make bias of decision that this business is automatically really good because of looking at one specific part of the year. but then if you also look at the other part of the year, the business might have not been doing really well. So then you might be like, oh, maybe this business isn't worth it. Maybe this business ain't cut out for investing. But then you're making that decision of a move. But then the main reason is the reason why the business is not performing as well is because of the season. It's business season. So then by looking at the financial statements, at these income statements on an yearly basis, you will get to know how a business can perform throughout the seasons, throughout the times when it has booming business and throughout the times when it has slow business. So then that's all about that. So then I highly advise you to check out these income statements on an annual basis. Now let's check out its components. So, components of the income statement. Component number one, revenue or sales. Now, this is the amount of money that is earned after the business has sold goods or services. Well, I pretty much believe that this aspect isn't a very much surprising aspect or very much new aspect. This is basically a part that shows how much money a business has collected after selling a product that it has to offer to its customers. So then second component, cost of sales. Now these are expenses that are related to producing or bringing goods or services which are sold by the business. So then these are expenses that are concerned with preparing a good or service or putting it in a state where it is fit for sales. You know, like for you to sell stuff, that stuff doesn't come for free. There is cost that a business has incurred in order to get that product or service in that particular quality and in that particular quantity for it to be sold. So the expenses that are behind the products or services, the expenses that were behind preparing these products or services are classified in the cost of sales. Now, looking at an example of such costs, there's materials and resources used for production, paying wages to workers that are concerned with bringing the goods or service up for sale, and etc. So then that's component number two. Component number three, gross profit or loss. Now, this is a surplus amount of money, that is if it's profits, or a deficit amount of money, that is if losses, realized after deducting the cost of sales from revenue. So basically, once you take revenue minus cost of sale, you will be able to get gross profit or loss. So then, if there is more revenue than more costs, then once you check out the difference, there will be a surplus amount of money as gross profits. But then, if there is more cost of sales than revenue, then after you do the difference between revenue and cost of sales, you will find a deficit in the amount of money, which is basically a gross loss. So then, example number one, if a business had created a revenue of 1 million shillings and spent 450,000 shillings as cost of sales, therefore the gross profits would be 550,000 shillings. So then that would be surplus amount of money. Example number two is if the business created a revenue of 1 million shillings and spent 1.2 million shillings as cost of sales, therefore gross loss will be 200,000 shillings. So then that will be deficit. Operating costs. Now, this refers to the amount of money that was spent in maintaining and operating the business in general. So then, leaving aside the matters of sales and costs that were put down to make the products or services be fit for sales, there's other expenses that are incurred in order to put the business on a running phase, like for the business to keep on operating, for the business to keep on producing on a day-to-day basis. There is expenses that are there. Now these are classified in the operating costs. So then, like I told you, this refers to the amount of money spent in maintaining and operating the business in general. Examples of such operating costs are research and development. Now research and development is basically an expense. This is basically an amount of money that is spent and that is dedicated towards researching on their business's product or service. By research, the business's aim is to come up with better ways of producing that particular product or service, better ways to deliver it to its customers, better ways to improve its quality, better ways to have it more appealing so that customers could choose this business's specific products over the rest of the business. So then all that amount of money that is spent on improving what the business has got to offer to customers, then this is basically classified in the research and development part of the expense, the R&D. Now, depreciation. Um, depreciation is basically the cost that is incurred on non-current assets. Now, basically, non-current assets. Will look more into this in the next video, but for me, let me explain it to you in easy. Non-current assets are basically assets that a business expects to own for over a long period of time, that is more than 1 year. Now, when these assets are first bought, they're usually at their best quality. When they're new, they're usually working well, they're usually at their best form of production. They're at their best quality. Now, as you gradually keep on using these assets, the more these assets go through wear and tear, the more these assets degrade, and the more that happens, the more as far as accounting is concerned, the more we realize that there's a decrease in value. Now, that cost that has been incurred, or that cost that was there, like as the asset was decreasing in value, we record that decrease as a cost. Now, that cost that had reduced the value of the non-current asset is therefore put forward as depreciation in the income statement to show that the business has used this particular non-current assets, and the business does understand that these assets are decreasing in value, so therefore that decrease will be counted as a cost, and therefore the business will be like the cost that the business has incurred in operating this asset will be classified as depreciation. So then that's depreciation. Paying salaries to administrative workers. Now, administrative workers, these are basically all other workers that are regarded in the business that aren't related specifically and directly to production. These could be managers, secretaries, CEOs, all those people. There's also other costs such as marketing, getting to promote the product or service, or getting to promote the business. All that stuff falls into operating costs. And then there is operating profits or losses. Now, this is the surplus amount of money, that is if it's profits, or deficit amount of money, that is if it's losses, realized after deducting operating costs from the gross profits or losses. So then there are 3 examples here. So then basically the operating profits or losses, you just basically have to take gross profit or loss minus operating costs, and if there is an amount of money that still remains after all that, then it's profit. If there is no amount of money that is left, that is if the balance is a negative, then that is a loss. So then, example 1, if the business created a gross profit of 1 million shillings and spent 450,000 shillings as operating costs, therefore operating profits will be 500,000 and 50,000 shillings. Example number 2 is if the business created gross profits of 1 million shillings and spent 1.2 million shillings as operating costs, then the operating loss will be 200,000 shillings. And lastly, example number 3 is if a business created a gross loss of 300,000 and spent 1 million shillings as operating costs, then the operating loss will be 1.3 million shillings. Now, remember, when a business has a loss, this typically means that there is still an amount of money that the business is obligated to pay. So then at this point, the business is in debt with some other expenses that it has failed to pay up. That's hence causing the loss, because there isn't that much revenue. That is there to incur through all these costs. Other income or expenses. Now, these are basically income or expenses which weren't recorded as part of revenue or operating costs, but have a contribution at figuring out the profits or losses of the business. So then this is basically extra income or basically extra expenses that the business has incurred that have no relation to revenue or the cost of sales that were put down in order to have the revenue, or the costs that are there to run and maintain the business. So then it's not there. So then it has nothing to do with all those. This is basically extra income from any other source of income that the business has. Or basically any expense from any other sideline operation. Like, oh, this extra income or this other income or expense has got nothing to do with the direct or with the normal schedule or the normal operations of the business. Now, an example of these other income or expenses could be the interest income or expense. Now, the interest income is basically money that a business gets when scenario one, either if it lends out money to someone else and or another party, and then the other party has to pay the business back with interest, although the business has is not solely, or the business's sole purpose isn't directly related with lending or matters of finances such as banks. That's case number one. Case number two is if a business had a certain amount of money in savings or a certain amount of money in a bank account, and then the bank decided to pay out interest to the bank account. So then that amount of money that the business gets will be recorded right here. Likewise, for interest expenses, this is when a business has lent out a certain amount of money from the bank and has to pay that amount with interest. So then the interest is recorded as other expenses. Now, notice that with these two examples, both interest income and expense had nothing to do with the products, had nothing to do with the services that the business has to offer. It had nothing to do with running the business on its day-to-day basis. So then that's why they fall into the category of other income or expenses. These are basically extras. So then there is income tax expense, which is a certain amount of money that is paid to the government. This tax is realized from what has been created as profits. If not profits, then revenue by the business. So then the income tax expense is basically an amount of money that the government sits down, looks at the financial statements and be like, as far as how you've performed this year, I am so gonna cut you this amount of money. Now they're gonna cut the amount of money basing on profits, that is if you have any, or basing on revenues. So then that amount of money they cut is basically the amount of money you pay to the government, which falls for income tax expense. And then there is the net profit or loss. Now, this is the surplus amount of money if profit, or deficit amount of money if loss is realized after deducting all expenses incurred by the business. So then after the business has paid out all of its expenses with all of the revenue it's had, after paying through all that stuff, the bottom line figure, the figure that remains down there, if there is still any amount of money remaining, that is, if there is still surplus, then that is a net profit. But then if the figure is in negative, if the business still has got some money that it has to pay, if it still has some debt, some amount of money it has to pay as expenses remaining left over, so then that negative figure, that is a net loss. So then this figure is realized after you've taken all your existing revenues, all your existing incomes, pay out every single expense you have, then that will result to the net profit or the net loss of that business during that specific period of time. So then the last but not the least important is the comprehensive income or expenses. Now, these are basically income or expenses that are a result of changes in capital of the business, except excluding the capital that has been funded by investors. Also, such income or expenses have got nothing to do with the normal business operations, and such income or expenses are added with the net profit or loss. So then basically, we'll know that the business has got capital. Now, this sort of capital we're talking about has got nothing to do with the capital that has been funded by investors, the capital that you as an investor has invested into the business. Now we're talking about the business's capital. So then we'll know that the business has got capital right now, right? Yes. So then, however way or in whatsoever way the business decides to use that capital, but of course with the aim of maximizing profit. Now, when that business uses that capital, we all understand that there's fluctuations in the value of capital. There could be an increase in the value of capital, showing that there's a capital appreciation, or there could be a decrease in the value of capital that could be recorded as a deficit. Now, that increase or decrease in capital, in the value of capital, is recorded as comprehensive income or as comprehensive expenses. Now remember, this is the business's capital. This has got nothing to do with an investor saying, oh my God, I funded this amount of money to that business. It is non-related to that scenario. This is the business with its capital invested in other sort of operations, or there's a business and how it's used that capital. And if these operations, which have got nothing to do, I repeat again, which have got nothing to do with the sole purpose of the business, so then if these operations have have brought surplus to the capital, then that is recorded as comprehensive income. But then if there has been a deficit, a plunge in the value of capital, then that will be recorded as comprehensive expenses. So, an example of such comprehensive income or expenses is the gain or losses from selling shares to another company. So then a business could have shares or could have invested into another business and have ownership of shares. So then if the business decided to sell them shares and if the business got profit from doing so, then that profit is recorded here. But then if it got a loss from doing so, then that loss is recorded here. Gains or losses from foreign currency exchange. Now, if the business had been swapping its money through different sort of currencies, and then if by any sort of chance whatsoever the business has made surplus from swapping values of currencies, then that surplus is recorded there. But then if due to such operations the business's capital has decreased, then that decrease is recorded right over here. So then these are a few examples, bunch of many more examples that could fall into the classification of comprehensive income or expenses. So then if it's comprehensive income, it is added to the net profit. If it's comprehensive expenses, it's deducted from the net profit, and then you get the total comprehensive income or expense. So then that will be the final figure in the statement of profit or loss with that extension and other comprehensive income. So then now you know why it's called statement of profit or loss and other comprehensive income, because this is an extra. This is an extra. So then that's that. Now, let's check out an example of such statements. So then here's an example of the statement of profit or loss and other comprehensive income for the year ended 31st December 2019. Now, this just means that the business operations that were recorded here in this particular statement are from a time period of as from 1st January to the 31st of December of the year 2019. Now, we have all these incomes, all these expenses. Now the business has shown us basically these statements in 2 years, like there's 2019 and the 2018. Now the reason why there's 2 years is just to give a sensible comparison between the 2 years and to show us whether the business has performed better or has performed worse than the previous financial year. Now, as we can see the components, there is revenue, there is cost of sales. Now, if anything's a cost or if anything's a loss, it's usually put in brackets. And these figures are actually read in billions and not millions. Like, for instance, let me read out the revenue from contracts with customers. That is actually read as 348,828,076,000. Now, you might read this as 348 million, etc., etc. But then you have to take into consideration that right on the top here, 2019, 2018, there's TZ shillings 000, indicating that for the sake of simplicity in presenting these income statements, the last 3 zeros, which are common to all these expenses, have been excluded, but then they've been summarized right on the top there. So then when you're performing your analysis or when you're reading through these statements, don't forget to factor in those 3 zeros that have been put up there. So then there's the revenue from contracts, there's the cost of sales, then we see there's the gross profit, then there is other operating income. We haven't talked about this in the notes. Now basically other operating income are basically, well, I could say income that the business has got from its day-to-day operating activities. Now, if you want to know what these operating income for this particular business could be, or if you'd want to know any other single expense or income that has been recorded in these statements, you can have a much more in-depth study of what it's all about by looking at the notes. So then, as you can see, for each and every single one of these incomes or expenses, there's a note right after they have been written. So then, for instance, other operating income, note number 8, you could simply just refer to notes to financial statements. They're written in numbers. Then you go down to number 8, which is other operating income, and basically read out what that was specifically about. So then these notes are written right after the business has finished presenting all of its all of its financial statements. So then the notes follow right after the financial statements. So then there's other comprehensive income, there's marketing and selling expenses, there's administrative expenses, there's depreciation and amortization. Now, amortization is basically the decrease in value of an asset as for a specific time period. Like let's say there's a certain non-current asset that you expect to hold within a specific period of time that is more than 1 year, and they're usually intangible in nature as such. So then basically that's the fall in value of that intangible asset, or of that asset with a fixed life, a predictable life, such as leaseholding. So then that deduction is recorded as amortization. Then there's other operating expenses, which brought down the operating profits. So then right after that, there's other income or costs, which fall for finance income, finance costs, net loss or gain on foreign currency translation, which brings us to the profit before tax. And then we have to cut down the income tax expense for us to get the bottom line profit of the year. And then there's other comprehensive income and expenses. So then we add them there, we put the cost, the comprehensive cost and the comprehensive income up together. Then we get the comprehensive loss or the comprehensive expense, which is deducted from the profit of the year to get the total comprehensive income of the year. And then there's finally earnings per share. Now, earnings per share is basically the profits of the year divided by the total number of shares that are in the company. So then the reason why there's the earnings per share is to show investors that for each and every single share that is owned by an investor, that investor, what has that share returned as profits? So then basically the earnings per share shows for each and every single share the business has been able to make for investors a certain amount of money, which is profits. However, the investor isn't going to fully realize these profits, or isn't going to fully claim these profits, as the business could either reinvest all of its profits or some of its profits and pay the other as dividends. And then so then basically the earnings per share, it simply just shows that for each and every single share owned by an investor, how much has that share given back as profits. So then, with that said, ladies and gents, thank you so much for watching this video. If you found this video very useful, if this video has been a lifesaver to you, please like this video, subscribe to our channel if you haven't, and click that notification bell so that YouTube notifies you each time we get to upload content onto this platform. Now, if you're also on other social media channels such as Instagram, if you're on Facebook, if you're on Twitter, you can check us out there on our social media accounts, all called Matrix Investing. We try to keep consistency in uploading content that is related to the capital markets, especially those of Tanzania. We focus there and we upload content relating to that. So then feel free to check out our content, follow, like our posts, share, save, do all that stuff. But then if you also have a personal question to ask, a question related to capital markets and investing in capital markets that are found in Tanzania, you can check us out there. You can DM us, we're a DM away, and we'll be happy to answer you. So with that said, thank you, ladies and gents. Have a nice day. Don't forget to subscribe.